Dayakar Puskoor is the founder and managing director of Dallas Venture Capital. A serial entrepreneur turned visionary investor, Dayakar launched one of the first tech-focused venture funds, investing in groundbreaking early-stage startups in cloud, AI/ML, and mobile technologies. In this conversation, we discuss Dayakar's venture journey, how startups get funded, how equity works, startup exit strategies, and much more.
Hello, and welcome to another episode of the Cloud Gambit. This is going to be an episode where we're kind of going down a different path with a few different areas. And for that, I have a special guest, someone that is an expert in these areas. So if you wouldn't mind introducing yourself, Dayakar.
Sure. My name is Dayakar Puskoor. I'm founder and managing director at Dallas Venture Capital. And my background, I started my first job at Motorola for 10 years. Then after that, started a company called JP Mobile, focused on mobile messaging software. And that company in 2000, we raised a bunch of money and planned to go public. Then 9/11 happened, did not go public. But then we were able to merge that company with a company called Good Technology. Then it was acquired by Motorola. I had a short stint at Microsoft. After that, then I started a venture fund. It used to be called Naya Ventures in 2012. Then 2021, we changed the name to Dallas Venture Capital. So now our fund has grown. First fund to now the latest fund, close to $150 million, AUM under assets under the management right now.
Awesome. So, first of all, I just want to say thank you for your time. Thank you for joining, and I'm really glad we could get this together and make it happen. I believe both of us. I think we happened to be on a rooftop eating dinner in Dallas, and I was talking to one of your advisors just about the challenges, for new technologists that are, or new engineers that are kind of going into the startup space with just understanding the equity component of it, understanding how venture capital works at a high level. A lot of those, there's a lot of misunderstandings and just not knowing, so I think this will be a good conversation. We can kind of dig down into a few of those areas. Thinking about venture capital, it's much sort of beyond funding, and that goes into how VCs support founders.
Sure.
Every founder at some point was a first-time founder, and many were actually engineers. So how does Dallas Venture Capital sort of support founders and provide value, say mentorship or strategic guidance or whatever, to just make a bigger impact and drive success for founders and for the startups?
Sure, William. One thing I wanted to say, congrats. Looks like you've been doing for a podcast for 1 year right now. Looks like you're coming up in August. I listened to some of them. I've done a great job with some of the founders. Listened to a few things. I learned a lot. What kind of questions you asked, and really how other people were able to provide good information. So it seems like it's a good session for me to kind of express what we do at Dallas Venture Capital. So as I mentioned, I came an engineer, as you mentioned, then became a founder, then really decide to go into venture. So a lot of people ask me why did you go into venture? From a founder. So I felt really I learned a lot, from my early days. We'll talk about how I have raised capital and all that. But from those learnings, I felt venture capital is one of the best asset class. All the if you look at a financial stack, to really if you want to contribute and also same time learn. I really feel like I learn every day from these founders, from the ecosystem players. So with that, really, but focused, B2B software, venture fund, and being in Dallas, and coming from, as I mentioned, with my technology and operational background, we want to make sure we add a value. All Most of the VCs do a great job, in my opinion, but we want to make sure what we say really show in results. To do that one, we have created a within our venture fund. Usually, most of the funds call portfolio growth. We created what we call a Dallas Venture Capital DVC advantage. DVC advantage is nothing but really how do we help our portfolio companies once they have product market fit or some traction, take them from that 1 million to $10 million revenue. How do we help them? To do that one, we actually created within this DVC advantage, we kind of call, we have 4 pillars. First pillar is really the most important pillar. How do we help them on the go-to-market strategy, business development, and sales? That's the biggest problem I have seen a lot of startups face, like I faced. I went through almost 7 VP of sales until we find the right salesperson. So that's where really I thought we can add most value, but not just saying it. We created even though we're a small fund, we have 3 full-time partners working on how do we help out these portfolio companies. Mostly they are coming from operational business development backgrounds, and using our own network of advisors and investors, we are able to have a goal to close at least 2 customers for a portfolio company, and not only closing 2 deals, but also how do we get them close to $1 million annual recurring revenue. As you know, that day when you met us, we had 3 or 4 of our advisors trying to talk to our portfolio company sales team what kind of hurdles they are facing, how we can help them, right? So that's, I think, really the first pillar. Second pillar is how do we help them hiring, mainly on the sales and financial side. One of the major problem I have seen, startups have a hard time recruiting good sales leaders, because really sales leaders come with a what I kind of wolf pack. They come with their team, and they had to make sure execute what they need. So to hire that kind of sales leader, until they get to series B and C, you will not be able to afford to hire those sales people, to be honest. I think that's what really we feel using our Rolodex and our network, how we can deploy these CROs. And we have done with a few of our companies. For example, Core.ai, CodeStack, we were able to actually help them, a VP of channel or a customer success officer. It made a big difference for the company. The third pillar we kind of call a follow-on investments. As you know, startup founders, they're, as you mentioned, mostly engineers. They're very good at really getting the product going, maybe raise initial capital, but when you had to do next level of capital or growth capital, you had to be prepared. So that's where we have a good set of relationships with other VC funds, and even some of the companies you dealt with, we invested. We were able to introduce them to growth capital funds, it could be Goldman Sachs, FTV Capital. Some of the funds, as you know, they deploy $40-50 million in growth capital. Then the last one is strategic partnerships. So these 4 pillars we really practice at DVC.
Okay. And kind of taking, I guess I got a little bit of, first of all, thank you for that. I think I got a little ahead of myself. One thing I wanted to just sort of think through, when a founder, maybe a new time founder comes to DVC, first time, maybe, what sort of key elements would a VC look for, in a pitch from a founder? And I guess can founders make their how would a founder make their pitch stand out, in the crowded, this crowded market right now?
Very good question. I think the first thing really we look for, then I'll talk about in general about I kind of call it 3 T's, team, total available market, TAM, and traction. So when I say team, the most important thing for a VC, because we want to make sure the team, the way I kind of look at, you can change always horse, but not the jockey, right? We want to make sure the team is the most, jive, from technology, a CEO, and also somebody able to sell. I kind of call it three-legged stool. Do they have at least, maybe they may not be able to get all three members right away, but do they have an idea once they get some funding, will they be able to recruit, somebody to work with them? Because, as you know, startup takes a long, long time, and to make sure like the team able to jive together. That's the number one thing, right? So the second one is really always, did the founder go through, what the total available market, the space they're planning to go to. They don't have it really, we'll try to kind of tell them and give some ideas how to do that research or get that data back to them. Then the traction, have they thought through, especially depending on where you are. If you are looking for angel investment, or basically what we call a pre-seed seed, you may not have any customers yet, right? But did you think through? So that's where really, depending on really where you are in a life cycle, could be a product definition all the way to getting that early stage, what we kind of call design partners. Have you thought through the design partners? And make sure like you get, what I kind of call a, within your network, you should be able to find 2 or 3, potential customers willing to give you that feedback. That early feedback is the most important thing. You want to validate what you're thinking. So I think that team, TAM, traction, then of course the technology also. Always people look at, because most of the investment really in the software side, as you know, started with the technology. Have they built it or did they think through where they are on technology? So I think then pitching to any angel investors or VCs, you want to make sure like really prepare your slide deck not more than 10 slides. I kind of call, if you have more than 10 slides, people get really frustrated to go through all the slides, right? So if you want, like, if we can send you a slide deck, you can share with some of these founders. I kind of call a first slide, start with really problem statement. What problem you're trying to solve, and then a second one would be like how you would solve that problem. So I will say like after you define the problem, what are the solutions you're offering, and the market size, educate your investor, because most of the time really we don't have all the knowledge as a founder has the area they are focusing. Educating the investor is one of the most important thing. And also, before going to this pitch, I would say do some research about the investor too. It could be angel investor. If the angel, especially make sure like they have some expertise in that area, they can help you, right? I mean, that's one thing I have seen. People think, just as long as I get the money, I can go and build the product, I can do everything. But in the early stage, this is so important, getting that angel investor who knows and can help you be a mentor. There's so many good angel investors nowadays. When I started my company, I don't think we had that many people really willing to work in the startup area. Now, so many people, been successful people, or some other executives in large enterprises, they're willing to be a mentor. So I think I would say like make sure like I get a mentor. So a few other slides I will say like a competition, pricing. Really, you want to make sure like you thought through. If you don't have all the ideas, it's okay. You could ask investors also what they think about the pricing. But once really kind of gone through what I kind of call a friends and family, angel investors, if you are going to a VC, even pre-series A, series A, you do have to have some, these things nailed a lot more than early stage. Then once you kind of hopefully get funded, people like us in pre-series A and series A, and they can help you to get to what I kind of call a series B and hopefully to next level. So I hope I answered the, what a founder should prepare in their pitch deck, and also how they should really educate themselves before going to any investors.
Yeah, that's great info, and I think that constraining the slide deck and requiring them to make their message very succinct and strongly suggesting that is something I think we all can learn from. If we're preparing content for anybody at any level. After founder gives their pitch, can you talk a little bit about the decision-making criteria that you use to evaluate? I know you talked about, tech, TAM, and traction. How do you take those um, focus areas and then map them onto a presentation that you've seen? Is there gut feel involved? Are there metrics that you use? How do you think about that?
Sure. Definitely, as I mentioned, like the team is the most important for us, right? So when I meet any founder, I tell our team, I can really get a gut feeling within half an hour. Are they really able to sustain for a long time? Because it takes 5 to 10 years for any startup and to have some type of really could be a conclusion you can call like exit or really whatever, right? So I think that's what I try to get the gut feeling. Then go to next level, right? So we invest, as I mentioned, mainly very focused B2B software companies, right? Within that also we invest in the what we kind of call infrastructure companies like Alkira, CoreStack, and companies like what we did like in the cybersecurity space and all that. So with that focus, we are able to even before we take a pitch, we have gone through a pretty good level of really the company technology. So then now really deciding on the team and what the traction so far, what they have made. Is the traction really what we kind of call like is a concentrated or really they have multiple customers? The one thing we look for, what I kind of call like a really, you don't want to put all, eggs in one basket. Like you don't want to have one customer paying, your entire revenue, right? One or two customers. It happens in the beginning, but have they expanded, customer base, right? So because we are looking at companies already have some, traction. I mentioned have close to $500,000 to $1 million, annual recurring revenue. With that, they should be able to have at least, depending on the company and what type of product they're selling, but at least they look at, they have $30,000-$40,000 per customer revenue, right? So with that, that gives a good validation. The third one, I would say, like within that customer base, have they landed and expanded? If the company even started $5,000, we are okay with it. But that gives you an idea. Customers really using the product. It's kind of funny. That day I was talking to one of the CTOs of a company. I was asking him about the AI. He said that a lot of pilots are there, but not many passengers yet. Right? So, and other end user using the product, right? If you don't have the end user using it, company is not going to expand, especially in the B2B SaaS. Most of the revenue comes really, it could be user based or it could be transaction based revenues, right? So if you are priced by user base, that means you want to make sure like expand, number of users using the product. So those two things really kind of gives us a good, idea where the company is right now. So then of course we also kind of look at, can we also get other co-invest with us? We do lead the rounds. Our basically check size are anywhere $2 to $5 million in a pre-Series A and Series A. But we like to get one or two other investors. Are they really willing to co-invest with us? Even the founder may have some people already, or we also try to bring other co-investors with us into the this round of financing. Our timeline is what we kind of have a goal, touch to term sheets. We would like to get it done within 3 months.
That you brought up kind of a point of, well, I guess got me curious about another question and something I get some questions about sometimes. But a VC fund doesn't just magically appear and populate itself. What role does a limited partner like an LP play in a fund, versus kind of like what a general partner plays.
Got it. Got it. So, as you know, VC funds, just to mention, limited partners are investors. Most of the limited partners are, silent investors, right? They're not involved in the, fund day to day. General partner, think of like a CEO running a company, basically responsible for sourcing. The way I kind of look at, there are three S's a limited partner look in a fund like ours. One is how we are sourcing, how we are selecting, what is our stewardship is. The stewardship is nothing but what I talked about, our DVC advantage. In our sourcing, selection, and stewardship, how these funds are making progress, how they have done. That's the way the LP should look at it. So limited partners, they invest anywhere depending on the fund. There are limited partners could be individuals, high net worth individuals who have exited a company or maybe an executive a company. They could also invest in venture funds. Then there are family offices, could be limited partners. Then the third or fourth I kind of call institutions. What we kind of call almost like some of them, like a California retirement, teachers fund, right? And a Texas teachers fund. They also invest in VC funds because they want to allocate their capital into different buckets. It could be hedge funds or real estate, some into the VC funds also, right? Then there are funds totally set up as a fund of funds. People really, they invest in VC funds like ours. They have experience really running a VC fund already, or maybe they were a part of a large institution like it could be Stanford or really or Harvard. They basically they're alumni funds. So those are the LPs. The GPs are usually people like me who coming from a background of really start a company, learned a lot, and hopefully able to invest their own money, and able to raise capital, because we also had to raise capital from other people. Or people also come from the investment banking backgrounds. People worked in different big banks and help basically fundraising for other startup companies or bigger companies. Then other people also come where they have done a pretty good job as a product manager, or really a good sales leader in bigger firms. They also join as GPs. But then there are other people also could be where they joined a venture fund as an analyst, grown in the venture fund as an associate. Then they will also leave and start a venture funds. So that's the way the GPs come. The LPs are, I've kind of mentioned 4 or 5 buckets. The GPs could be coming from 3 or 4 different areas.
Okay. And so this kind of, I eventually want to pivot to sort of how employees of a startup should think about equity and compensation. But I have one last question on, I guess, just the funding and the investment cycle. So as startups grow and they begin to scale, there's, likely going to be some sort of subsequent funding rounds. And when this happens, additional shares get issued, which causes dilution of ownership to some extent for existing shareholders, within a company. Is there, is that something that, maybe a potential employee that's going to look at a startup to maybe work there, that they should understand? And can you kind of give a brief explanation of what this means, both in the context of the founders and the team that's running the company, and also it also impacts VCs as well. They have to think about this when they go to invest as well.
So it's a really important question. So if you look at right, I always tell people, if you don't have to do fundraising, you should not do it. We would rather really you can grow the company keeping most of the equity for yourself. But in technology side, it's pretty hard because technology is changing so fast. You need to move fast. As you know, like really, if you look at top 8 companies in the world, all venture funded companies. If you look at Amazons of the world, Googles of the world, every one of them, they did a great job. So able to basically grow the company faster, right? That's the reason really you want to raise funding. So with that, I would say like when venture funds come and invest, you want to make sure as a founder you had to know how much dilution you're going to take. You're going to take some dilution, but you had to be very clear what the dilution will be. The more traction you get in the early stage, the less dilution you take. Because when venture funds are coming in, they look at what kind of risk they are taking. And if the company, as I mentioned in those 2 T's, one of the traction, if they have a pretty good traction, they get better valuation, right? Depending on the revenue and all that. So that's the number one thing is the founder should focus and try to get the traction before go to a lot of funding. Try to go to friends, family, or angel investors. Get the product market fit, PMF, as quickly as possible with some good customers and revenue. That makes a big difference. So I would say really initial fundraising, when you go for series, and all that, rule of thumb is maybe you give up 30% of equity, right?
Okay.
You're still keeping 70% for founders and also to your employees and all that, right? You do want to create a environment where not only you as a founder, you should definitely benefit because you're the one started, or founders, I should say. But same time, you want your team to feel also have skin in the game. From the day one, you want to make sure like set up at least 20% of your equity for employees. If we never like to invest in a company, they're not thinking about their employees, right? And ecosystem players too. When I talked about really these advisors or mentors, you can't afford to pay them. They cost a lot of money if you had to pay. But if you can give them some equity, they also will help you. They feel that they have skin in the game, right? So that's from that 20% pool, you can really take care of your employees. That should be replenished whenever you do next to fundraising too, by the way, right? Initially you will be giving up maybe 5-10%. Then when you want to hire a good VP of sales, you may have to give up some more equity to those employees. So I think really for me, successful companies have done a great job. Sometime unfortunately founders think hey, I not know the whole pie. For me, is more than really, instead of owning a small pie, I would rather own a small piece of big pie. And that's the way I look at it. Even my own company, we raised capital and $3 million revenue. Until that, we did not go outside at all. So only from angels and all that. But sometimes when you are really going into some of the stuff what's happening in the AI space, as you know, it requires a lot of money. Really, you really need that capital just to run the infrastructure and the AI models right now. It costs a lot of money. I'm pretty sure you've been hearing how much OpenAI spent really for them to get the model, where they are today, right? So I think that depending on what you're working on, but the beauty of really, I'm pretty sure, you've been working on the cloud. With the cloud, you can start a company nowadays with $500 in a bank and get a account on Amazon, get started. Then really, of course, eventually you had to get good funding for you to grow. So I think to answer your question, I hope really I told you like the founder need to make sure like get some advice in the beginning itself, how they really get diluted each stage in a series A, B, C. But I would like the founders to own, when the company exiting, a pretty good chunk of the company. We want to make sure like the founders get the most benefit. Then of course the employees, of course the investors too.
That's really good information. Appreciate that. And I guess we don't have too much time left probably, but one thing I really wanted to discuss is just thinking, if you're an employee, and this is something that Yvonne and I both are like really interested in, is understanding equity. So if you think about like many top engineers out there will give up a lot of base salary in favor
Mhm.
of, some founder stock or good, maybe like a restricted stock options plan. And, you know, when they go and work for a startup. And I know a few of the common types of options like incentive stocks options and like non-qualified stock options, or even like, RSUs, restricted, stock options. Um, what should what should a employee that's seeking to go and, work for a startup understand about how these work, and also when they negotiate? Because what I see a lot of times is, engineers or new timers are just confused about this, and they're actually afraid to ask questions, and they're going out and they're looking on the internet, and there's just so much out there. So, like, I guess just trying to boil it down to as simple as possible answer, if it's even possible.
Sure, sure. And you're exactly right. It's kind of funny. Uh, my own company, I remember, most of these young engineers, and I was also young that time, didn't understand much about the stock options. And I learned some. Then when I used to give stock options, most of the time they never understood. Hey, no, I don't want any stock option. I want my salary increase. Them, some of them, they used to have like, I want to get to my number they have. But I'm glad to see some of these employees benefited a lot. Were able to buy apartment or house when we exit our company. So that made me good satisfaction as a founder, a CEO of the company. Yeah, really it's important, when you're giving up a good job in a bigger company, where they're also the big companies also nowadays they give, basically stock grants, and those stocks you get from a company like a Microsoft and all that, they're liquid also, right? Once you get it, within 1 year or so you can sell it and make, some, at least to use that money for buying a house or something, right? But when you're joining a startup, it's a long journey. You don't know when are you actually going to make that money. So that's one thing you had to get to your head. You are here for long term too. But good news is, I'll tell you, there are some options available for some of these employees. Where when I started, it was not there. That time, once you join a company, until the company exits, you don't have any exit plan at all. So you want to make sure, like, understand how many actually stocks the company has, right? What are you getting? 0.01%? Are you getting 1% of the company through your employee stock options? That's number one, right? And most of the time, really, the good news is the stock option the price is lower than the actual price, really, the common, other investors are paying. So usually you get a strike price, which should be a lower than really, what the price is going for. And that's where it makes a difference. But they had to make sure, understand the tax implications also. They need to consult their CPA if they're getting a lot of stock at lower price, and if they're going to exercise it. And there are some implications. Until you exercise, there are no problem. But once you exercise, there are some, tax implications they need to consult. So again, how many stock grants you're getting, and how the vesting happens, right? Is it a vesting? Most of the time is a 4-year vesting. Most of the startups do, because you want to make sure both sides, giving the time to make sure the company grows, right? So with that vesting, then what the strike price is, and do you want to exercise those, options once you're able to exercise. Once you exercise, nowadays there are also options available. When the company raising next level of capital, you should be able to tell the CEO or the founders, hey, when you are raising next level of capital, I would also like to take some chips off the table. That's happening right now. Before, it never used to happen. Even founders, even initial angel investors are taking some chips for the table when they're doing a Series B or Series C fundraising. So you should be educated and talk to your CEO, whoever it is. Don't be afraid of, hey, I would like to take some chips for the table. If you need it, if you need the cash, if you don't need it, if you believe in the company, go for it. But it's always better to take some chips for the table. I always encourage nowadays even the founders, because you've been working with the shoestrings and really taking less salary. You do need to make sure like you take care of your family. So you want to make sure like you get some cash out. So I think those are the good, at least really evolving stuff is happening in the venture world. It was not there before.
Yeah. So, let's say somebody is looking at a role in a startup, and they take some shares. And is there a mechanism for them to sell those shares before exit or before the org goes public? Like, is there a way to exercise that capital? As an employee for a privately held company.
Yeah. As I mentioned before, we did not have that many options. But now, as I mentioned, when the company is doing next level of fundraising, the Series B investor, sometimes what they call, they're buying primary shares, and they're also buying what they call secondary shares. The secondary shares are nothing but really employee shares or angel investor shares. And you could, you don't need to sell all of your shares, but you could sell some of it, because they're, the founder or CEO want to make sure everybody gets an opportunity to sell some of the shares, right? You may get some allocation too. Then if the company progress very well into Series D and all that, plan to go public, nowadays there are some platforms available. People are coming and buying employee stock actually, and what they call a pre-IPO stock. That's also available nowadays. You see like some, even I saw like right now some of these companies like OpenAI and all that, they're not public. Some employees already selling, and people like us, we could go and buy in open market. It's not a public market, but there are systems set up like that. You can go and buy them.
I would imagine if you have pre-IPO shares and you believe in the company, then you would have to think very carefully about whether or not you wanted to sell those pre-IPO. Because if people are wanting to pick them up, it's likely people believe that it will be more valuable after IPO, right? So you'd have to think long and hard about whether or not the cash now is worth it, and what that risk calculation is post IPO, right? It's that's an interesting calculation, I would think.
I agree with you. I think that's depending on. I always tell people, right, especially if you're young and all that. If you believe in it, keep it. The company more than anybody else, right? Why you want to sell it, right? So, but same time again, there's nothing wrong really. I did not do, be honest with you. When I raised capital, we owned 80% of the company, and the investors who are coming in, they asked us, do you want to sell some of your equity? I was like, no, I don't want to do it, But it's always good to take some chips on the table. I'm not saying all of it, but they should think about some cash out.
What about like so you can like exercise? So exercising is like a multi-part process, but you can exercise options early sometimes, and for the audience, this just means purchasing your stock options before they're before they're vested, at a time when like your strike price and I guess like the fair market value are closer together, to avoid getting just obliterated with taxes. Am I saying that correctly?
I think, William, most of the time you can't exercise, options until they're vested. Once they're vested, you have option. You buy it, not buy it. Usually you have like the company's queue, like in the stock option plan. It is clearly one thing you want to make sure, read the stock option plan. When somebody gives you, it should detail everything, right? How long you can keep, even if you leave the company, how long you can keep those stock granted, vesting happens. So I would also recommend, request your manager or CEO, all of the stocks should be vested sometime really, and some goals also, not only the timeline, but also you can set up goals too, and they should be vested. Or really, the company is sold, you should make sure like all your options get vested. So I would not recommend really, like any company, any of the company cannot do, really, let you, buy, your equity unless they are vested. But once they are vested, if the strike price you have to look at depends on really, the company, right? Like, what do you think if the company is going to be get acquired? You want to make sure, like, really, at least the stock options, really, the shares you are buying. Once you acquire, those are your shares. If you keep for 1 year, more than 1 year, then you pay long-term capital gains, right? If you really, if the company is going to get acquired within a few months, then you'll be paying, like a regular ordinary income tax. So you need to look at really, again, depending on, which company you're in, you want to exercise those, stock options.
All right. Yeah, I guess it makes a lot of sense, to not see yourself as a financial advisor and, be read up on the internet, but having a real financial advisor in these situations is highly recommended.
Yes.
I would say.
yes, it is. Sometimes, as you know, like, I don't know, this is my first company, this is in 99 and 2000, when they had a .com bust happened. Unfortunately, a lot of these employees, they hit by so much of stock. It was a big crisis. I don't know if you remember or not. Maybe you're young that time, but it was a big crisis.
One last thing that just popped into my mind, just kind of from your last answer, a little bit was, so we've been talking about we've talked about startup exits just a little bit, and you were talking about like acquisition. There's certain, like, I imagine, profiles of companies that are suited for IPO versus not. What indicators might a startup see or experience, that make it a good fit to IPO?
Yeah, I think really, it's all, I talked about the 3 T's, right? Especially, is the team also has expertise, or will they be able to go and get good CFO? There's one thing, in my own company, we are planning to go public. We went ahead and a good CFO, right? So the team need to have a combination. Going IPO is very, very expensive, and it is really very taxing for the company, because now every month you have to produce the results, every quarter you have to produce the results. Otherwise, market is not gonna like you. So right, so that's one thing that you have to make sure you're ready for that stuff, right? Number 2 is really, it's all depending on really the market size, right? You want to make sure, this company goes IPO, is it 100, 200, $300 million revenue it can generate by itself, right? Or, does the team has expertise to go and acquire other companies once they go IPO, for them to get to the $300, $400 million revenue, right? So if you look at, I think there is a number, I think almost 95, 97% of companies get acquired, right? Versus going IPO, especially nowadays, right? Like, really, most of these acquisitions also happen less than $300 million. So I think, those are numbers are there. You want to make sure, depending on, where you are, the product, and also the team, the traction you got, if you can really prove those 3 things, really, you should be able to prepare for yourself for IPO. But otherwise, you should always look at, how you could be a major role, played in a bigger platform, right? There are really, that's where I tell most of the founders, start really kind of, I hate to say, but almost like a, dating these bigger companies, while, you're building the product. For me, I was fortunate enough to work with Microsoft and other companies while I'm selling my product. So, right, they should become your kind of, what I kind of call a sell with or sell through partners. Their sales team is selling, their product team really knowing your product, it makes a huge difference. It's a lot easier when you're looking at exit. When a product team kind of makes to their corporate development team saying like, "Hey, we do need this product," versus you going through the corporate dev stage. So I think my advice to founders: always look at what the best path for you and your employees and your investors.
Gotcha. Thank you. That's great advice, great guidance. We're definitely at time. We used, I think, the whole block. So I guess this is where it ends. And I just want to thank you. So thank you for being so giving with your time. And I guess do you have anywhere on the internet that you post or do anything like LinkedIn or Twitter or any of the social platforms?
Mainly LinkedIn. I would say like I'm not on Instagram or anything like that, but I am. But I don't think I post a lot on Instagram. But on LinkedIn, I do post some of my thoughts and especially some of it is on technology, and also I post a lot about our portfolio companies because they are the one really doing actual work. So I like to promote them and the founders. I don't know you have seen or not, but we post a lot about Alkira and lately some of the investments we have done in a company called Dice. So we've been doing a lot of really why would you invest in a company also, and their company making any product announcements or any other major partnership they have done. But I do post my own really. I'll be hopefully able to give you other good news. I'm hopefully finishing up a book actually right now. It's kind of
nice.
almost what the questions you asked about it. I'll be able to send you once the book is done. So I'll be posting some more about the book.
Great. Yeah, I don't know the timing on that, but I think we have a few episodes that are going to be launching before this one. So maybe we could time it with the publishing of the book. I don't know if it would work out, but we can discuss the logistics.
Sure. No, thank you again, both of you, taking time, and really enjoyed your questions, especially pertinent to founders and also employees. It's very, very thoughtful what you thought about it. Always we think about founders, but really, you guys really thought about employees is very, very important.